Today on Real Estate Backstage, the inflation rate has ticked back up, which leaves the Fed divided on how to proceed with potential rate cuts. LoanDepot finds itself in hot water over alleged violations of Reg Z, and proposed legislation seeks to eliminate capital gains tax on home sales. All that and more today on Real Estate Backstage. Now, before we jump in, if you're watching on YouTube or if you're listening on Apple Podcasts or Spotify, make sure to subscribe to the show. That way you don't miss any future episodes. And if you're looking for the show notes with links to all the articles that we're going to cover today, you can find that at realestatebackstage.com/episode 33. Now, if this is your first time watching or listening, I'm your host, Michael Smith. I'm the CEO and broker in charge here at Bluefield Realty Group. We're a 3-time Inc. 5000 company headquartered here in Greenville, South Carolina, and we provide real estate brokerage, property management, and insurance services. Now, we're going to start with inflation, which is everyone's favorite topic. This is according to Connect CRE. Quote, the Consumer Price Index climbed 2.7% year over year in June, according to data released by the Bureau of Labor Statistics. That matches consensus estimates, but marks a rise from 2.4% in May and 2.3% in April. The core CPI, which excludes volatile food and energy prices, rose to 2.9%, in line with forecasts, but slightly higher than May's 2.8% reading. On a monthly basis, headline inflation rose 0.3% in June, in line with expectations, following May's softer 0.1% increase. Core CPI rose 0.2% month over month, just below the 0.3% forecast, and edging up from May's 0.1% pace. The latest inflation figures are unlikely to shift the Federal Reserve's stance heading into its July 29th and 30th policy meeting, with futures markets still pricing in only modest odds of an imminent rate cut. Instead, this June CPI print is the first of 3 key data releases, including the June Personal Consumption Expenditures, the PCE index, and the July CPI, that will shape policymakers' views on whether inflation risks warrant a policy shift ahead of the September 16th and 17th FOMC meeting. For now, the report suggests that recent inflation gains reflect steady demand and still firm services prices rather than any broad-based spike. However, economists warn that the full impact of President Trump's escalating global trade war has yet to appear in the data. With new tariffs on the European Union and other major trading partners slated to take effect August 1st, many expect price pressures to build in the months ahead, potentially complicating the Fed's path forward toward rate cuts as it tries to balance growth concerns with sticky inflation, unquote. Now, the Fed is rather divided on how to proceed. There are some members of the FOMC who have vocalized their intent to vote on rate cuts. There are others who are more wait and see, more cautious. Jerome Powell would fall in that latter category. Now, this is according to the Wall Street Journal. Quote, a brewing debate inside the Federal Reserve over how to address risks posed by President Trump's tariffs threatened to end a period of relative unity, with officials potentially at odds over whether new cost increases justify keeping interest rates high. In recent weeks, Fed Chair Jerome Powell has indicated the central bank might have a slightly lower bar for cutting rates than seemed possible this spring, when larger tariff increases threaten to meaningfully push up prices while weakening the economy. A rate cut isn't expected this month. Instead, Powell has sketched down a middle ground where milder than expected price readings or softer employment data might be enough to justify cuts by the end of the summer. A lower threshold than more obvious signs of deterioration the Fed might have required when larger tariff hikes prompted forecasts of more sharp inflation increases. Trump's announcement of larger than expected tariff increases in April derailed Fed plans to resume rate cuts this year by creating concerns around a stagflation scenario in which growth weakens and prices rise. In that environment, Fed officials would have likely needed to see the economy slow to have more confidence that price increases would be short-lived. Powell has suggested the Fed might only be a few cuts away from a neutral stance, suggesting any resumed rate reductions would likely be limited and gradual if the economy can avoid a serious downturn. The Fed's June meeting minutes, which were released on Wednesday, point to 2 broad groups on the central bank's rate-setting committee. A sizable minority didn't expect to cut at all this year. They are fearful that after 4 years in which inflation has run above the Fed's 2% goal, customers will grow more accepting of higher prices, and businesses will have greater reason to test their appetite. A larger group expects cuts this year, thinking tariff costs might not prove large enough to risk persistent inflation, or that the labor market will soften, or both. But most want to wait a few more months. Within this group, so far only 2 officials, Fed Governors Christopher Waller and Michelle Bowman, have signaled their desire to resume cutting rates as early as this month. They are the only 2 policymakers appointed to their current posts by Trump who has fiercely criticized the Fed for not taking more drastic action. Waller has for months said he expects tariffs will lead to a small, one-time increase in prices that won't generate higher inflation beyond this year. He was recently joined by Bowman, who had previously been much more concerned about inflation. They are ready to cut without waiting to see more data, unquote. All right, so shifting gears, Rocket has officially closed on its acquisition of Redfin. This occurred on July 1st in an all-stock deal valued at $1.75 billion. This is according to Inman. Quote, mortgage giant Rocket Companies completed a reorganization of its capital structure on Monday. In announcing the completion of its reorganization in a regulatory filing, Rocket said it reduced its classes of common stock from 4 to 2 in what's called an Up-C collapse that will improve its ability to use its common stock as acquisition currency for future deals. That includes Rocket's next big acquisition target, which is Mr. Cooper, the nation's biggest loan servicer, for stock valued at $9.4 billion. Company executives have said that acquiring Redfin will help subsidiary Rocket Mortgage capture 8% of the purchase loan market, and the Mr. Cooper deal will put Rocket in touch with more homeowners who might be ready to refinance. In reporting first quarter earnings in May, Rocket executives said the Mr. Cooper acquisition remains on track to close by the end of the year. Rocket announced on June 3rd that it would issue $4 billion in debt and use the proceeds to retire notes held by Mr. Cooper's subsidiary, NationStar Mortgage Holding, Inc., unquote. So like I've said before, Rocket is obviously trying to take over the world. That's fairly obvious. Now, the Redfin acquisition has been getting the most publicity, especially in publications that you and I read within the real estate industry. But the Mr. Cooper acquisition is actually a much bigger deal. And that's not just in terms of valuation, but really in terms of the strategic importance to Rocket's overall goal of creating that end-to-end experience for the customer. All right, in other news, this is according to Inman. Quote, a newcomer to the so-called portal wars announced a major partnership on Monday. A new portal named Address USA has teamed up with Gannett, one of the nation's largest news publishers, to provide another space for consumers to view homes and generate referrals for agents. Address USA, an upstart attempt to go national with a platform that has been tested in a few regional markets, would tap into Gannett's readership as part of the years-long commitment the companies announced. With the move, Address USA joins a crowded group of portals offering consumers a space to view listings online. By teaming up with Gannett, the company lands an audience that could make it a serious competitor, and Gannett gains a new revenue stream via referrals. Real estate information and tools are important to our audience of 195 million average monthly unique visitors as they search for a home to buy or sell, or simply want to explore properties as real estate enthusiasts, Mike Reed, Gannett Chairman and Chief Executive Officer, said. Address USA will enable us to drive further audience growth and engagement, enhancing the overall experience for readers to be inspired by what's available in their local market. Address USA now becomes the latest competitor looking to go to battle for consumer attention with behemoths like Zillow, Realtor.com, Redfin, and Homes.com, all of them much larger and more established brands in the space. Rather than leaning on heavy financing, Address USA seems to be leaning into media partnerships to help it gain momentum in the crowded market, unquote. Now, I tested the website out, addressusa.com, and I got to tell you, I was definitely not impressed. So unless they start investing a lot of money into web development, to making it a better product, a better experience for the consumer, I really don't see this going anywhere. So speaking of portal wars, Homes.com is actually making some substantial progress. This is also according to Inman. Quote, CoStar added another 6,300 paid members to its Homes.com platform in the second quarter of the year as the parent company continued its focus on its residential real estate services and positioned itself as a top competitor to other portals. Between its last earnings call in April and its second quarterly earnings reported on Tuesday, CoStar increased by 50% the projected number of salespeople who will be selling memberships on the platform to 750 by the end of the year. The company reportedly generated 111 million average monthly unique visitors across its network, which includes Homes.com and 11 rental sites in the Apartments.com network and the Land network. The portal's parent company's total profit was $6.2 million, which was 68% lower than the second quarter of 2024. The company has recorded an $8.6 million net loss so far this year, unquote. So a few of our agents have actually reached out to me recently to get my opinion on Homes.com. A few of them have recently jumped on a Zoom call with the sales team to see, what the pitch is all about. The agents at least my agents that have gone through the Zoom meeting seem to indicate that it's a pretty good value. From what I've seen, the monthly fee is pretty low. They'll boost all of your listings, and they'll actually retarget anyone who looks at your listings on Homes.com and place some social media ads to try and drive them back to you and your listing. So seems like an interesting model. I think Homes.com certainly has better odds than anyone else who's trying to break into this space and compete against Zillow, Realtor.com, and the others. Now, speaking of Realtor.com and the portal wars, Realtor.com has acquired Zenlist. This is according to Housing Wire. Realtor.com parent Move Inc. has acquired Zenlist, a real estate tech startup known for its agent-client collaboration tools. The deal boosts Realtor.com's mobile-first capabilities, aiming to modernize the home search experience and empower more than 35,000 agents with smarter, more connected tools for today's shifting real estate landscape, unquote. So I had never heard of Zenlist before reading this article, so I took a quick look at it, and it seems like a pretty neat concept. So the whole philosophy there is it's an app that you set your clients in for them to use when they're looking at homes, and you collaborate with them within the app, natively within the platform. So you set them up in Zenlist, they download the app, they get alerts, they look at properties, you can see their activity, you can suggest homes to them through the app they might want to look at, they can send messages to you, they can request a showing, ask questions. So basically it just makes it a little bit more of a seamless process to collaborate on their home search rather than having to, copy and paste a URL or take a screenshot, from Zillow or Realtor.com or your website and text it to you. So it's an interesting concept. It'd be interesting to see what Realtor.com does, if they integrate this more within the existing Realtor.com platform or if they keep it more as a standalone product. Again, it is Move Inc., which is the parent company of Realtor.com that made the acquisition. All right, in other news, a class action lawsuit was filed against LoanDepot. This is according to RIS Media. Quote, a group of mortgage borrowers has filed a federal class action lawsuit against one of the nation's largest mortgage lenders, alleging it systematically violated federal loan officer compensation rules to boost profits ahead of going public, according to a federal complaint filed July 15th in the U.S. District Court for the District of Maryland. The federal complaint, Nathan Johnson and others versus LoanDepot, LLC, alleges that LoanDepot operated a sophisticated, years-long scheme to systematically circumvent and conceal its willful violations of the loan officer compensation laws set forth in the Truth in Lending Act, according to court records. 5 named plaintiffs from Maryland, Virginia, and Florida claim that LoanDepot also violated Dodd-Frank regulations by tying LO compensation directly to loan terms, a practice outlawed after the 2008 financial crisis. The complaint also mentions potential federal criminal violations, including wire fraud, securities fraud, and false statements. According to the lawsuit, LoanDepot linked the commission paid to loan officers to the rates and fees that consumers paid and concealed these violations from borrowers and regulators through an elaborate system. The company's LOs typically earned 1% of the loan amount as compensation for each loan they originated, which is consistent with industry standards. However, when loan officers couldn't secure higher rates from borrowers, the company allegedly slashed their compensation or eliminated it entirely, directly violating federal compensation laws. The plaintiffs allege that LoanDepot used so-called internal loan consultants, or ILCs, to mask the compensation cuts tied to its loan pricing. The lawsuit explains how LOs were forced to transfer borrower files to these ILCs when customers refused higher interest rates. These transfers were sham transactions where there were no actual transfers of the loans to the ILCs. The ILC assumed no additional duties, and the original loan officer continued to perform the same duties but at a reduced commission rate. The complaint alleges that LoanDepot required its LOs to falsify internal forms explaining these transfers, often forcing them to claim the moves were requested by customers rather than driven by pricing. LOs who refused to do this received no compensation for the work on those loans, the complaint alleges. If the loan officer could only get the borrower to move forward at a lower rate, LoanDepot would pay the loan officer substantially less, for example, 30 basis points, or would pay the loan officer nothing on that loan, according to court documents. The lawsuit also claims that LoanDepot used an automated electronic system to place ILC signatures on federal loan disclosure forms under penalty of perjury, even though the ILCs had no actual involvement in originating the loans. This practice allegedly created false federal loan documentation, suggesting ILCs were responsible for loans they never even handled, unquote. So this is a big deal if the allegations are true. After the 2008 financial crisis, the law was changed to prohibit lenders from adjusting loan officer compensation based on the rate and terms of the loans that they were originating. Now, this was done to remove the incentive for loan officers to put customers in products that would yield a higher APR to the lender. So it appears that LoanDepot may be in some hot water here. We will certainly keep an eye on the story as it progresses. All right, in other news, Fannie and Freddie are set to begin accepting the VantageScore 4.0 credit model. This is according to Housing Wire. Quote, Bill Pulte, the director of the Federal Housing Finance Agency, the FHFA, announced via social media that Fannie Mae and Freddie Mac will, with immediate effect, accept the VantageScore 4.0 credit model. The government-sponsored enterprises, however, will continue to consider credit scores from three bureaus called Tri-Merge Scores. Since he joined the FHFA, Pulte has pursued changes to the current credit score requirements by the GSEs. His comments were directed to Fair Isaac Corporation, FICO, which licenses one of the most widely used credit risk assessment tools in the mortgage industry. In a Tuesday morning post on social media platform X, Pulte said that effective Tuesday, to increase competition to the credit score ecosystem and consistent with President Trump's landslide mandate to lower costs, Fannie and Freddie will allow lenders to use Vantage 4.0 score with no current requirement to build new infrastructure. After the hard work by many great senators, including Senator Tim Scott, I'm extremely disappointed to hear about the cost increases by FICO onto American consumers. FICO stock declined sharply after his comments, dropping roughly 25%. It's not entirely clear if the agencies will eventually move to a bi-merge credit reporting score in underwriting models. Under the Biden administration, there was an initiative to move to two credit reporting agencies to increase competition and lower costs on Fannie Mae and Freddie Mac purchased loans. The FHFA has mandated the use of VantageScore 4.0 alongside FICO Score 10T for GSE purchased mortgages. Mortgage lenders were to begin delivering VantageScore 4.0 scores for newly originated loans in Q3 2024, with full implementation scheduled for the fourth quarter of 2025, but it was pushed back indefinitely. VantageScore estimates that using their credit model result in approximately 33 million more consumers nationwide having access to a credit score that may aid them in obtaining a mortgage. Silvio Tavares, the president and CEO of VantageScore, said in a statement that the FHFA's move aligns with the 2018 Credit Score Competition Act. This decision is a big win for the mortgage industry and for millions of Americans who are creditworthy and will have the chance to buy their first home. Modern credit scores like VantageScore that use both credit report data and alternative data, including rental payments, are long overdue for use in the mortgage industry. VantageScore has already been broadly adopted in other credit industries like credit cards and auto loans, Tavares said. In another social media post, Pulte said the change would expand credit access to millions of forgotten Americans, people who live in rural areas, renters who pay their rent on time every month, and bringing down closing costs. In a statement to Housing Wire, Scott Olson, the executive director at the Community Home Lenders of America, the CHLA, said the announcement is a win-win for both consumers and lenders, unquote. So I'm excited to see this roll out. I think this is definitely a needed change for a couple different reasons. First of all, more competition against FICO would probably be a good thing to bring down the overall cost of credit reports for lenders, which hopefully those cost savings will be passed along to consumers as lenders compete for business. But also, I think in general, just the credit scoring models that we're using today in the mortgage industry are outdated. The FICO score, I don't believe, is the end-all, be-all. It's not the most accurate way to predict whether or not someone is going to make their mortgage payments. I think if you have someone who has been making on-time rent payments for years and years and years and years, I think that is a pretty good indicator of whether or not someone will be able to make a mortgage payment if it's a similar pricing structure. Now, if you have a big price shock, if you have someone who's been able to make a $1,500 a month rent payment on time, now they're applying for a $3,000 monthly mortgage, maybe that's a different story. But if you can show that someone has consistently been able to make their rent payments on time, as long as the pricing shock isn't too big, I think that should translate into a high likelihood, a high correlation of someone who's going to be able to make their mortgage payments on time. So excited to see that roll out. All right, shifting gears, existing home sales fell 2.7% in June, this is according to RIS Media. Quote, after a jump in inventory and only a slight inch up of existing home sales back in May, June saw existing sales and unsold inventory drop, per the latest report from the National Association of Realtors. Existing home sales have dropped month over month by 2.7%, or 3.93 million at a seasonally adjusted figure. Unsold inventory crept down by 0.6%, meaning 1.53 million units, putting current inventory at 4.7 month supply. Year over year, existing home sales were unchanged, but there was a 2% increase in median price, $435,500, the highest ever for June per NAR. In a media call walking through the data, NAR chief economist Lawrence Yun attributed housing demand and sales not picking up to ongoing affordability challenges, such as high mortgage rates, unquote. So far this year in 2025, we've seen the existing home sale market slowly pick up and continue to recover from 2024, 2023. However, in June, we saw basically a flat year over year with no change. So we're seeing a little bit of a mid-summer slump. All right, this is exciting news. Could we see the end of capital gains tax on home sales? This is according to RIS Media. Quote, during a press conference on Tuesday, President Donald Trump suggested his support for a bill proposed by Representative Marjorie Taylor Greene, Republican from Georgia, earlier this month. The proposed No Tax on Home Sales Act eliminates federal capital gains tax on the sale of primary residences. Families who work hard, build equity, and sell their homes should not be punished with massive tax bills, Congresswoman Greene said in a release. The capital gains tax on home sales is an outdated, unfair burden, especially in today's housing market, where values have skyrocketed. My bill fixes that. Though Trump did not specifically mention Greene's bill, he pledged his support for no taxes on capital gains from home sales, unquote. So the way this works currently, under current law, if you have occupied a home as your primary residence for 2 of the last 5 years, if you sell that property and you have a profit, if you have a capital gain, you are exempt from paying taxes on the first $250,000 of gain if you're single, or $500,000 of gain if you're married and you file your taxes jointly. So if you're a single person, you buy a home, you live there 2 years, and then you sell it, if you have profit of $250,000 or less, you're fully exempt. You're not paying any capital gains tax. If you're married filing jointly, you can have up to $500,000 of capital gains, and you're already exempt from paying any taxes. So this new bill, who would it benefit? It would benefit people who sell before that 2-year mark. So you buy a home and then 6 months later, your life circumstances change, you sell, you've got some capital gains. Now you're not going to be stuck paying those taxes under that situation. Or it would benefit people who have lived there for 2 years before they sell, but they end up having a very, very substantial capital gain. So more than $250,000 if they're single, more than $500,000 if they're married filing jointly. So this would benefit people who sell before the 2-year mark, and it would benefit people who either have held their property for a long, long time and they've seen a lot of appreciation, or people who live in more expensive markets and are more likely to see that big of a gain within a shorter period of time. Now, again, this is proposed legislation. Who knows if it will actually pass, but it would be certainly interesting if it did. I know we've certainly had some clients over the years who would have benefited from something like this. All right, here's some news in the commercial real estate sector. This is according to Connect CRE. BlackRock Inc. said on Monday it had entered into a definitive agreement to acquire Elm Tree Funds, a net lease real estate investment firm with $7.3 billion in total assets under management as of March 31st. Upfront consideration will be paid primarily in stock, with the potential for additional consideration subject to Elm Tree performance over the next 5 years. Additional financial terms were not disclosed. Upon closing, Elm Tree will be integrated into the Private Financing Solutions, PFS, the new platform created through BlackRock's combination with HPS Investment Partners, a part of BlackRock. Founded in 2011, Elm Tree has developed significant corporate and developer relationships and a broad geographic footprint, including 6 office locations and investments and 122 properties across 31 U.S. states. Now, you've probably heard a million times from people who honestly have no idea what they're talking about that BlackRock is the reason why homes are so unaffordable in the United States today. They allege that BlackRock is buying up all the single-family homes and competing with normal home buyers. But that is just not the case. In reality, BlackRock does not own any single-family homes in the U.S. We've talked about this before on the show. This has been debunked over and over, but you'll still see this circulated on social media that BlackRock is buying up all of these single-family homes, making it impossible for normal home buyers to purchase in today's market. Now, the company does have some indirect involvement in single-family real estate. That's primarily through providing loans to developers and mortgage companies, working capital loans, and they do hold shares in REITs, companies like American Homes for Rent, but they don't actively purchase any single-family homes on their own. They're primarily in the commercial sector through REITs, commercial investments, and providing funding. All right, shifting gears, there's an uptick in MLS reciprocity agreements, which I am personally very excited about. This is according to RIS Media. Quote, Stellar MLS, the largest multiple listing service in Florida and Puerto Rico, announced today that it is collaborating with California Regional MLS, CRMLS, and Bright MLS to expand their customers' listing access through the California and Mid-Atlantic regions. Through a program called Reciprocal MLS Access, a collaborative agreement between multiple MLS organizations, customers can search and view listings in other participating MLS systems without needing to join them separately or pay additional fees, seeking to allow more referrals and opening up access for buyers across the continent. In a press release, Stellar MLS called the arrangement a powerful tool for referrals and collaboration. This collaboration between Stellar MLS, CRMLS, and Bright MLS marks a defining moment in our shared commitment to delivering unmatched value to our mutual customers, said Mary Jo Cowan, CEO of Stellar MLS, in a statement. By connecting the three largest MLSs in the nation, we are breaking down regional barriers while empowering agents and brokers with seamless data access, expanded referral opportunities, and a stronger foundation to serve their customers. The direct impact of this type of data share agreement is still unknown. Notably, since the pandemic, Americans are moving shorter distances, and cross-country relocations have fallen significantly from recent heights. But the agreement represents a closer collaboration between MLSs that claim around 280,000 total members and 230,000 listings, as the industry grapples with questions around listing access and the appropriate usage of private listing networks. It also comes as brokerages have sought to pressure MLSs over certain mandatory NAR rules, most notably clear cooperation, unquote. So a similar effort is underway here in my state of South Carolina. Several MLSs across our state are entering into these reciprocity agreements to share data and allowing agents to basically log in and access data and see listings without having to pay the fees to join that MLS. So I'm always happy to see this type of collaboration, mergers, acquisitions, consolidation. I think within this particular sector of the industry is very beneficial. I do, from just a philosophical point of view, I understand the desire to have a bunch of different MLSs because at the local level you might do things differently. You might want specific fields. And it spurs competition. If there's just one MLS and they're not doing a good job and agents don't have any other choices, I understand the need for competition to kind of spur MLSs to do better, provide better value, better service to their clients. However, the siloing of data just makes it really, really difficult for agents and companies that have a large geographic footprint to operate. It just makes it more cumbersome. So, for example, I'm a member of 14 different MLSs. It's a lot of dues to pay, a lot of logins, a lot of different systems to learn. So whenever I see things like this, it does make me excited for the future of our industry. All right, we're going to wrap up today with a segment called Ask Me Anything. This is where you ask questions and I answer them. Today's question comes from Jake. Quote, how do you foresee AI changing the real estate market in the next 5 years? Are there any AI tools that you are currently using that you want to share? That's a great question. So AI, of course, is going to dramatically change things. Now, is that going to happen in the next 6 months? I don't know. But over the next 5 years, I think we are going to see a dramatic shift in how we do things with the advent of AI becoming smarter, and particularly with AI being able to plug into more things. So right now, AI is really kind of standalone and siloed. So for example, you have ChatGPT that you can interact with. I do like to use ChatGPT, Perplexity, Claude, different tools like that. I'm still kind of experimenting to see which one's my favorite. But ChatGPT is a good example. I think most agents are using that at some level. And it can be used almost like a research assistant, like a writing assistant. So you can ask it questions. It can do what's called deep research and search the web for you and pull answers to your questions, give you sources. I've used it a couple times in just prepping for the show. So ChatGPT can be great. I know some agents use it to create listing descriptions as well. So if writing isn't your strong suit, you can use ChatGPT as like a rough draft of your listing description. And just like with anything, it's garbage in, garbage out. If you're not good at crafting the prompts, you're not necessarily going to get the best responses from tools like ChatGPT. So I think one thing you definitely need to be doing is researching how are people coming up with the best prompts to really pull the best results out of the AI. So if you're asking it to create a listing description, give it certain words that you do want it to use, certain words you don't want it to use, things that are kind of overused in our industry, certain buzzwords that you see over and over in listing descriptions. You might ask it to omit those phrases or rephrase things a certain way. But you can just say, hey, help me create a listing description. I've got a property in Greenville, South Carolina with this many bedrooms, this many baths. It's close to this amenities. It has these features. You can just give it bullet points, like bullet point format. 1, 2, 3, 4, 5. These are the things I want you to mention. And I want you to craft it in a welcoming, professional tone, and it will write a listing description for you. Or you can do research on things like if you're interested in a certain lead gen strategy. If you want to start calling for sale by owners, for example, or expired listings, you could ask ChatGPT to search the web for some of the most effective scripts that you can use when calling FSBOs, or what are some of the best ways to get phone numbers to skip trace. So you can use it, and you can prompt ChatGPT like, hey, you are a real estate coach. You coach real estate agents at a high level who do a lot of production. Your specialties are XYZ. Coach me on how to do this. And you can really role play in the written form with ChatGPT. So that's an existing tool that I think a lot of people use. Now, I've used ChatGPT recently almost like as a web developer assistant. When I've been creating certain things in Zapier or different API integrations, trying to make our different pieces of technology talk to each other sometimes is difficult. So I've actually used ChatGPT. Hey, I want to make this happen in Zapier. I'm connecting this app and that app. This is the trigger. This is the outcome. What specifically do I need to put in this field in Zapier? How should I format this? And it's like having a web developer friend that you can call and ask questions to walk you through things. So it's definitely gotten really, really intelligent at certain things. So again, that's a tool that I think a lot of people are familiar with. Now, our CRM that we use, Follow Boss, they've recently introduced some really cool AI features as well. They record the phone call, so they will do not just transcripts, but AI summaries of the call. But they will also now, they have these buttons you can push when you're crafting an email or crafting a text message from within the CRM, and it will actually look through all the history with that lead. So if you've had email conversations, if you've had text conversations, if you've had phone calls where you guys have mentioned certain things, certain properties, the AI knows what you have discussed with the lead so far. And our CRM is integrated with our website. So we have all the data on what properties our clients are looking at on our website. So the AI within Follow Boss can reference that. It can know what properties they're looking at, what we've talked about before, and it can create a text message like as a follow-up, a check-in, based on the things you've already talked about, which is really, really cool. So if you're not just naturally great at writing or crafting messaging, even if you are, you just want to use it to save time, that's a really cool feature. Something else we're experimenting, we actually just signed up for this. It's called Maverick. And one of the components of that technology is an AI role play system where you can actually call it, and it has different phone numbers based on the scenario. So if you want an easy buyer lead versus like a confused buyer lead, an upset buyer lead, a seller lead, a website registration versus a portal lead, there's all these different scenarios, and each one is a different phone number. You call that phone number, and you're having a conversation with an AI. It's going to give you objections that you have to, overcome, and then ask for an appointment. And then when you end the call, it emails you a score. It ranks you, 1 to 10, and then it will give you coaching feedback on what you did well on the call and what you need to improve. So we're beta testing this right now. We're excited to roll that out to our agents and see how it works. Something else we just signed up for that we're about to implement over the next couple of weeks is called House Whisper. This is basically an AI assistant that you can text with or call, and it integrates with Follow Boss. So if you wrap up a showing and you're driving to your next appointment, you can call the AI and say, hey, I just met with so-and-so. This is what we talked about. And it will put notes in your CRM for you. It will update the stage of the lead. It'll create tasks, create appointments for you. So it's like having an assistant that just does things for you that you can talk to while you're driving, and it integrates with the CRM. So we're pretty excited about that. Now, like I mentioned earlier, a lot of these AI tools are really siloed. So you might have AI built in directly with your CRM that you can do things in your CRM. You might have ChatGPT over here that you interact with to get ideas, but then you still have to take that out and put it somewhere else. So for example, if you're using ChatGPT to help you write a blog, you put the prompt in there, it creates something, you still have to kind of copy and paste and pull it out and then put it into your WordPress or whatever website you use to manage your blog. All these different tools, all these different software companies are building their own internal AI infrastructure to help you be more efficient utilizing that technology, and that's great. I think the real magic is going to happen when ChatGPT or some other company really cracks the code on creating one centralized AI assistant that you can use anywhere. So it has your login for your CRM, for your Zapier, for your blog, for the MLS, for Showing Time, for Supra. If you can give it all your login info and train it on how to do things the way you want it to do things, and it's really just like having an employee that, hey, these are the 5 tools you're going to use, and I'm going to spend some time training you on how I want you to do these things. That's where the real magic can happen, where you can call your assistant or text your AI assistant and, hey, I want you to do this in this system, and then that in that system, and then that in that system, and then it can go and execute on all those things. That's where the real magic is going to happen. That's really where it's going to create a ton of leverage. I think, like I said, the fact that all these different tech platforms are creating their own internal AI use cases to make better use of the technology, that's great, but you still have to log in and execute and do things in all these different systems. If we can get to the point where you can just have a phone call with your AI assistant and it can log into your Facebook and post something for you. It can log into your CRM and do something for you. It can text one of your clients and set an appointment. It can go into Showing Time and schedule a showing for you. That's where the real magic is going to happen. And I think definitely within the next 5 years, maybe even within the next year or two, we might get to the point where something like that is possible. Now, are we going to get to the point where real estate agents are completely obsolete and buyers are just using AI to buy homes? I don't think so. We might get to the point where maybe 1%, 2% of clients are doing that. But I think, I forget where I heard this phrase, but I saw this recently. AI is not going to put you out of a job. People that use AI are going to put you out of a job. Now, certain industries are definitely going to be disrupted more than others, but I think service-based industries where we're giving fiduciary advice, so like a financial advisor, real estate agent, insurance agent, things like that, I think it's not necessarily AI that's going to put us all out of a job. It's going to be the agents that use AI at a high level that are going to compete and succeed. And if you don't get with it and you learn how to use AI, you're definitely going to be left behind. Think of it as if you're an agent who never adopted the use of the internet and you're still doing everything by hand. You don't use emails. All of your communication is sent through the mail. You're still trying to use a fax machine in 2025. If you didn't get with email, you didn't get with the internet, if you don't get with AI, it's just going to make it much harder for you to do your job. You're going to be much less efficient, much more difficult to compete with other agents. All right, so that's my rant on AI. I'm actually going to be out next week. I'll be in Myrtle Beach with the family, so I'll see you here in 2 weeks with another behind-the-scenes look at the real estate industry. Just a reminder, if you want the show notes, you can find that at realestatebackstage.com/episode 33.